Welcome to Financial Planning for Oil and Gas Professionals, hosted by certified financial planners Justin Brownlee and Jared Machin of Brownlee Wealth Management. The only podcast dedicated to those of you in the oil and gas profession to help you optimize investments, lower future taxes, and grow your wealth. Learn more and subscribe today at brownleewealthmanagement.com.
Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're doing a lightning round. We're going to talk about three heavy-hitting topics. We're going to talk about Berkshire Hathaway. We're going to talk about Elon Musk and SpaceX and the crazy IPO and what's about to happen there. And then we're also going to talk about a chart that blew my mind about retirement, people living paycheck to paycheck.
That we might disagree on.
We might disagree on it. And then if we have time, we'll talk about data centers. And we'll probably, that point, we'll be more asking our listeners for help because y'all are more engineers than we are. Justin, I've got to say, man, I don't have headphones on. And our YouTube listeners know we've had headphones. In this episode, we do not have headphones, and it's a little jarring.
Jared, I love it. I feel free. I feel light. I feel good. I'm loving life without the headphones.
It's weird because I've gotten used to hearing myself twice, once through the headphones, once through, just my regular voice. So it's kind of disorienting, but it's a good thing. It's a good thing, and I think we look good. So it's going to be a good episode. I want to share, so Berkshire Hathaway just had their first Omaha Investors Summit, sans Warren Buffett at the helm. I thought it was just a good time to kind of revisit him because I think he popularized value investing, and I think he's honestly one of the best investors of all time. And depending on who you ask, he can make a case for him being the GOAT of investing. And I think these two data points are really fascinating because they tell two very different stories. So the first one, so from 1965 to 2024, Berkshire Hathaway compounded at 20% a year, compared to 10% for the S&P 500. So Warren Buffett took over in 1965. If you bought it when he took over at the helm and you had a 99% drop, Berkshire would still have compounded at a rate higher than the S&P. Astounding. I don't even believe it.
That's remarkable. So that's from Bloomstrand, St. Louis guy.
Yep. He runs a value strategy, does a ton of great work on Berkshire if you're an active investor and active value investor. So hey, that's insane. But also, you got to juxtapose that with the most recent performance. So over the last 10 years, the S&P is up by 326% and Berkshire's up by 235%. So lagging by about 90%. Still great performance, but it's just crazy, right? You're lagging by almost 100% over the last 10 years. But over the 65-year period, you compounded at nearly double the market and you could lose 99% of your value and still have outperformed the market. What are we to make of those things? And also, I would love for your thoughts more generally on what does Warren Buffett mean to investing and what can we learn from him?
The 99% drop stat is truly unbelievable. So, and that's a testament to just how wildly successful he was for those first 50 years. Also, really interesting to note that they are materially losing to the S&P 500 over the last decade. But you're still more than doubling your money in Berkshire. So it didn't have a bad decade necessarily, but relative to the S&P, it sure did. A lot of things come to mind. I think some of them are just, if you purchase a business or you operate a business and it is enormously successful, an individual business can compound at a rate that is so far beyond the market as a whole. Jared, I think it's also a good reminder. We've talked about this before, that a lot of people don't necessarily think investing in stock is similar to being an investor in art. And, the 30-second version here, if you're investing in art or you read a story in the Wall Street Journal of some investor that made hundreds of millions of dollars in art, most of the time, the way that they made a fortune in art is they bought 1,000 pieces of art. And 3 of them ended up being bangers. 3 of them ended up having a 100x or more return. 997 of the art pieces did not. So a lot of people have this thought that, okay, that's how you make money in art, but the stock market's different. In reality, it's not that much different. The way that the market produces a 10 or 12% long-term return is a very small number of companies have extraordinary years. And boy, Berkshire saw a lot of that in those early decades.
Yeah. I think regime matters. We talked about this with the podcast with Phil McGinnis a little bit, but is it a good strategy that is out of favor or is it a bad strategy? When the sentiment and froth is all in large cap tech, Berkshire is naturally going to underperform. It's just more durable businesses, more predictable cash flow streams, right? So it's like less sexy, right? So like there are environments where Berkshire underperform, but I think like it gets back to like investors really having a ton of conviction as to what you're doing. But I think the wrong takeaway is, how do I find Warren Buffett? I think he is a one of one. You also have to recognize like the structural reality, right? Like if you think about Berkshire Hathaway, the underlying mechanics of the business, there's a great paper that decomposed Warren Buffett's alpha, or like edge, if you will. If you think about Berkshire Hathaway as a business, they own a lot of insurance companies, right? And if you think about insurance, essentially you kind of get some leverage opportunity. You have easy capital available to you, right? You take in premiums and you pay out claims. You essentially have all this money and some future unknown liability, but it creates a pool of money, a reserve fund that creates a ton of operational efficiency, and it really easily gets capital to people, right? So you could deploy that in various ways. And again, you should be more conservative with that pile of money. But Berkshire had this pool of assets, this other pool of capital. And two, when Warren Buffett started investing in 1965, there was informational arbitrage. Like I could know that a company that See's Candy was selling themselves for less than 1x book value, right? And that wouldn't end up on an article somewhere that everybody could look up. There was an informational edge because information was so much less efficiently distributed, right? So I think a few lessons are, man, Warren Buffett is the man, and he has such a high degree of conviction in what he was doing.
Right.
But also you have to set expectations of when is this going to outperform and underperform, because it will. Berkshire's underperforming over the last 10 years, which is just part of it, right? So if most people would say 10 years is a long time to invest, not really. Right? Because you might come to the wrong conclusion about this company based on this, right? And you don't look further back. So really long-term is better, and long-term means decades, not just over a single regime.
Jared, there is one topic that I want to cover with Berkshire, but before we dive into it, why do you think the last 10 years have been significantly worse than the 50 prior?
Yeah, it's the same reason it's hard to be bullish going forward, right? Like Berkshire's sitting on just less than $400 billion in cash. I think there's a few things structurally. With a company at that size, it is very hard to put capital to work. If I'm going to buy like a micro cap, if I have, let's say, $1 trillion and I want to invest a 10% position in something, there's a ton of the investable universe that I can't even invest in. I have to acquire it, right? Like I can't
you would be
size
buying
a position.
The entire company.
Right. I can't size a position
1,000 times.
Exactly. I can't get into it without materially moving the market because of how big my position size is. So I think cash friction matters, right? Like, hey, if that money is not invested in the market, you're naturally going to earn less in returns, right? Because if the equity market's outperforming the rate of cash, that's naturally a friction, right? I also think, it's hard to put more money to work. And then also too, I think a lot of the 1965 to, we'll call it 1985 Berkshire, the information asymmetry has compressed a little bit. Again, I still believe in Berkshire. Their capital discipline is remarkable. Market cycles are going to continue to happen, and they deploy capital at the best possible times and on the best possible terms. It's hard to be bearish on Berkshire, but it has gotten harder for them, right? I wouldn't want to be Greg.
I think that's well put. I would say this. I want to repeat something you just said, Jared. I'm definitely not going to make some active bet against Berkshire. What an incredible, disciplined company. But if we're talking about the difficulty that they have faced recently and the difficulty that they will continue to face, it's really similar to what we've seen from mutual funds and ETFs, just any giant fund over the last 50 years. So one of the greatest innovations to the everyday investor since 1970 has been the massive explosion of mutual funds and then today ETFs. What that has done is it's turned it from a situation where, hey, if you're an investor in 1959, you need to call a stockbroker and purchase a number of stocks that you want to own and pay the commission to own them. And then hopefully you manage them well over the years. Compare that experience to buying funds. It easily, quickly, immediately gives you passive exposure to a ton of companies, in many cases, hundreds or thousands of companies in one fund. And that has been instrumental in there being tens of millions of millionaires created over the last 60 years just from investing. Jared, one thing we found with funds, whether it's Vanguard, Fidelity, or any of the other dozens of massive fund families, one thing that has been true pretty much at all times, when a fund has incredible performance, what happens? Money rushes in. tons of cash rush in. They make the top fund list and investors all flock to this fund. So the fund, maybe they were deploying 100 million in their first few years. They have this incredible outperformance. And then we're in a situation where now they don't have 100 million, they have 600 million. So the fund manager is in this impossible situation. And the fund manager has to take these excess funds and figure out what the heck am I going to buy with it? That is the situation Berkshire is in. They have such an unbelievable historic cash position. I believe no company has ever had this strong of a cash position. So the question is, what do they buy? And that cash drag in an efficient market like stocks, it's really hard to overcome. A month or two ago, I was at the Marble Capital Conference, so private real estate firm, and they were talking about how they were going to continue to have a little bit of cash on hand because they're investing in private real estate deals. So that is a night and day different situation than a company or a mutual fund that's investing in public stock. The stock market is very efficient. Private real estate, not as efficient. And so if you are operating a private real estate fund, you better have enough cash on hand for something that could go wrong or to be opportunistic. There are a number of reasons why you must have that cash on hand, even if over the past 5, 6, 7 years, you haven't needed it. But then you go back to Berkshire or you go to any mutual fund. Well, that cash on hand, that is going to be a drag on future performance. It's going to be incredibly hard for you to continue to beat the market like they did for the first 50 years or so.
Yeah. And I think there's just a lesson here. To use an athlete analogy, investing in Berkshire in 1965 was like Michael Jordan at UNC, or even high school Michael Jordan. Very hard to identify at the time. In hindsight, it makes a ton of sense, but just a very different profile, right? It remains to be seen what buying Berkshire today is like, but we hope it's not Washington Wizards Michael Jordan. So like, again, you can't just extrapolate, hey, this investor was good and they've been good for decades, so they're going to continue to be good. Because that's a very different opportunity set and universe than what you have today. But again, I'm rooting for them. All the success in the world. I admire them. I think their business is remarkable. I'm bummed I never made it up to Omaha. Well, Warren and Charlie were kind of leading the charge.
Should we talk about people making $500,000 a year living paycheck to paycheck now?
Yes.
Some rage bait?
Yes. Goldman Sachs has a new retirement study, and they've surveyed a bunch of people, about 5,800. They did this poll. We'll send the whole survey, but this would really caught my eye. And Justin and I are going to hash it out here. So how would you describe your situation? 3 buckets, paycheck to paycheck. Oh, the other thing, this is a diverse set of participants, right? Whatever that means, we can't really know. And again, surveys are fascinating. So paycheck to paycheck, moderately improve each year or considerably better. And they look at less than 50,000, 50 to 100, 100 to 200, 200 to 300, 300 to 500, and 500 and beyond. The mind-blowing thing here, I read most of this, and this chart stopped me in my tracks. 40% of people with over $500,000 say they're living paycheck to paycheck. Compare that to people making $200,000 to $300,000 a year. Only 16% say they're living paycheck to paycheck. Compare that to people with $100,000 to $200,000 a year. Only 25% say they're living paycheck to paycheck. And people with $50,000 to $100,000 a year, 36% said they're living paycheck to paycheck. So a higher percentage of people making $500,000 or more said they were living paycheck to paycheck than anyone between $50,000 a year to $300,000 a year. That is insane to me. What do you think about that?
Jared, I feel like you are probably going to take the position that, hey, this is all self-created problems. And if you're making, what's also interesting, 300 to 500, 41% say they're living paycheck to paycheck. So if you're making over 300,000, over 40% in this survey are claiming that they're living paycheck to paycheck. Jared, I think if we could filter the data and simply map out where do you live and did you buy your house before 2020 or not, I think the numbers would look horrible. So I think it's mostly people that are under 35 years old who maybe haven't bought their forever home yet and they're living on the coast. I think a ton of them, like I think vast majority of them are living paycheck to paycheck. And that's the cohort in this survey that is answering that.
That's struggling. Yeah. I also think too, right? Like, again, we've talked about the mechanics of employment compensation. If my professional working years were the 80s to the early 2000s or even today, the percentage of my income that is replaced by company contributions via 401k match and pension is a crazy percentage of my income. We'll see people all the time that retire. They never made more than $200,000 a year and they're retiring with $6 million. Corporate compensation has completely changed. Pensions are gone. So if you think about these people, this person making the $500K a year, they're thinking about, hey, I spend $300K a year and what I'm going to need to save to recreate $300 a year indefinitely is a crazy number. And I don't have a pension. All I have is a 401k match and this equity compensation. So I think like these people have, getting back to like the phase of life you're in, they have inherited a very different set of circumstances. The amount they are going to need to save to recreate their paycheck in retirement is multiples different than the generation prior. People in their peak earning years. I'm with you. Like you said, I was going to say this and now I'm saying it. I think there's also like a behavioral lesson where who you spend your time with matters, right? I do think there is some adjustment with the coast and stuff, but I also think it's fascinating. If you think about the 500 plus rung, part of why people think 500K plus are living paycheck to paycheck, A, there are more costly cities, and B, there's no upper bound. Meaning the person making $10 million a year and the person making $600,000 a year are both in this cohort. And they both probably associate together and they both probably do the same things. Once you get to that upper bound, who you surround yourself with and what your hobbies are also matters. And again, I also think they inherited a very different set of circumstances. So how long have you been making 500 grand a year? You could even carve that out. If I've been making it for 15 years versus this is the first year I hit it and I'm just now having to buy a house and stuff, very different circumstances. But I do also think there's a behavioral lesson in here. And again, to what extent? I don't know because we can't see the geographical dispersion, but I do think it's fascinating that even 300 to 500 too is all higher than the smaller rungs objectively.
That's an interesting point. So you're kind of saying, hey, there's a giant difference between making 700,000 a year and 7 million a year, and they're in the same rung, and that is a cosmic difference. If you're making 700,000 a year, you should not live in Manhattan and summer in the Hamptons.
Right.
But you're more likely to because you're around people who do. And that is a life that you should not do unless you're making 7 million a year.
Right. Your peer group is remarkably unhelpful.
Yes. Your peer group is making a ton more than you. How did you phrase it? We were talking about this earlier. There is not a huge difference between 98th percentile and 99th percentile in earning. There is a mountain of a difference between the top 1% and the top 0.01%.
Right, exactly. And that kind of becomes more of your reference point. So I think part of it is a reference point issue.
And yeah, if you are a young person and you're making 600,000, that seems like, hey, dream come true. This is the greatest thing ever. But there's a really big difference between LA, Manhattan versus Birmingham. And you can have a great life and you can have a 50% savings rate in Birmingham. You can't pull that off in Manhattan.
I think we agree more than we disagree here. Things this nuance and things that are measuring vibes, remarkably fickle.
Yep.
But I would say this flies, everybody talks about the K-shaped recovery where lower income people are kind of struggling and upper income people are all good and it's all great. I think this kind of refutes that a little bit.
I think it's a really good point. Jared, I think there's going to be a premium, a massive premium on, do you have an ability to earn your top 1% income independent of geography? That's obviously a superpower because, I just said big difference between Manhattan and Birmingham. Well, the tough reality is there's just not many jobs in Birmingham that pay $700,000 for a 31-year-old. There's a lot of those jobs in Manhattan.
Right. For the one respondent in this survey of 5,000 that's an investment banker who's allowed to work remote and makes $500K and lives in Birmingham, I'd say she's probably saying her situation's considerably better.
But, how possible is that?
But that's the thing. The cool thing is it's more possible than it's ever been.
True.
All right. Well, speaking of kind of state migration, income, all that stuff, we got to talk about SpaceX. You sent me a tweet that was also just kind of mind-blowing. What was it about?
I have a tendency to exaggerate, so I don't want to exaggerate too much, but I think it's got to be accurate. I think this is probably the most unique liquidation event in the history of the world, or at least in a city of Austin's size. And Austin is a big city now, obviously, but still just truly remarkable. SpaceX is set to IPO, and by some estimates, there are going to be 12 early employees that because of this IPO, they will now be billionaires. And then around 150 or 200 people are expected to make over $100 million from this IPO. So again, about a dozen new billionaires and about 160 or so that are making over 100 million. And this is from Chris Powers at Fort Worth Chris on X. And I think we can also assume that there are an incredible number of people that, yeah, they're not going to clear 100 million, but they are going to be now in that 8-figure area where they're going to clear more than 10 million.
Insane. What do you make of that?
It's impossible for me to not remember. I can't even remember the name of this person or exactly when it was. But Jared, I think there was a state representative in the California State House in 2020 who tweeted FUCK Elon Musk. So, they tweet F Elon Musk, and I believe he just responded noted, or he responded message received. Now, I am in no way implying that SpaceX immediately made a move because of this lowly state representative tweeting something mean to Elon Musk, but that is entirely indicative of the posture, of the attitude that the entire state of California had to SpaceX. It's extremely indicative of that posture. They did not appreciate SpaceX. They did not cater to them. They were not asking, hey, how can we make this a better place to do business? How can we make our state, our region, the best place in the world for people who are making tens of millions of dollars? And obviously, Texas prides itself on being a place that does exactly that. And so Texas kind of has open welcome arms for companies in situations like this. History went the way it did, and SpaceX started migrating to Texas. Was it 6-7 years ago? And then they have formally, I think the official icing on the cake was 2024, when SpaceX was completely out of California and officially a Texas company. And so just really interesting that there are going to be hundreds and thousands of people that are unbelievably wealthy. And all of that is going to go into Texas, home builders, car dealerships, every type of discretionary expense that you can imagine. It's really just going to flood the Texas and the Austin economy.
I have so many thoughts here. One, coming from Northwest Arkansas. Northwest Arkansas is an unbelievable place to live because the Waltons have made it their Sims. They have decided, hey, we're going to leverage all this financial capital to make the region that is home to our people and our lives remarkable.
They literally just put like billions of dollars.
Billions, right? So it packs above its weight class in terms of trail infrastructure, art infrastructure, because a wealthy family consciously made that decision. So the downtown consequences of this are going to be awesome. There's people in here that are going to change the trajectory of Austin. And also too, Southern California, where the company was based before, a lot of military aeronautic infrastructure. So what does this do to that base long term? I think that's fascinating. I also think it's sad for California, right? Like in my story, we talked about before they were in Hawthorne, their office was in El Segundo. I used to walk by it. My friend's house was close by. It's like across the street from my middle school. It's sad to think about this company just building all of this infrastructure and just being there for years and then all of the wealth flying elsewhere. That's kind of sad. But I also think capital needs to go where it's supported. If you're an oil and gas professional and you're thinking about investing in the IPO, you are the exit liquidity of this tweet. Right? It's such a fascinating conversation because this is so awesome for these people. But think about how late you are to the party if you're going to buy this IPO. It's kind of this interesting conversation that I don't think you and I have talked about enough. The average company goes public at so much bigger of a size than it did 50 years ago, just because private markets, capital formation has changed drastically. If you wanted millions of dollars in capital, really going public was the only way to get that. And now that's completely changed. We have billions, companies worth billions and billions of dollars where the broad public doesn't get to participate till it's a deca-billion-dollar IPO.
I imagine, and I know that there are financial advisors, whether it's Merrill Lynch, JP Morgan, UBS, who are selling their services on the ability to access the SpaceX IPO, and that is preposterous. By and large, you should never view an IPO today as this magic golden ticket for you to create wealth. Certainly not some investment vehicle that's so special that you've got to go with this company because they're going to have access.
Again, you have to keep in mind, what are you buying? The reason why these people are making the amount of money is because they were engineers when this was an idea in a warehouse in Hawthorne working 80 hours a week.
Right.
They already have the contracts. They're already huge.
Yep.
People are saying this is going to be $1 trillion IPO. Show me the discounted cash flow that even backs into that at a 50x valuation, right? And again, I'm not bearish. I'm not going to be the guy who bets against one of the best entrepreneurs of our time. He'll figure out a way. But the go forward returns, when are you buying it matters. You can't just have the right investment thesis. You also have to buy it at a price that's reasonable.
Totally. Jared, could not agree more. I've said on this podcast several times, I think California is probably the greatest place in the world. And so it is sad that they treated this company so ridiculously, that Texas is now getting all of it. But what an unbelievable kind of boom. Can you imagine all of this liquidity being reinvested into Texas startups and Texas opportunities? It's pretty remarkable.
Yeah, don't sleep on Texas. But Justin, okay, so we don't have a ton of time because we're already 10 minutes to topic. But the data centers are tangential to this because like the pro-business, pro-Texas, everyone's going to Texas, which is good. But also data centers are another piece of this. How do you think about that?
I really want to talk about this, and I'm glad we're doing it on SpaceX. Jared, there is something about SpaceX that is very special, and that is I kind of view it as like what capitalism has been for most of our life. And that is, I truly believe the average American does not fully understand the scale at which America has created an endless amount of middle-class millionaires because they have just worked at great companies.
There's no historical precedent for it.
It's truly remarkable.
Yep.
And SpaceX is probably the craziest example of this because people are not just taking this job and getting 5 or 6 million, they're getting tens or hundreds of millions of dollars. But I think that's been this incredible benefit of the American economy over the past 60 years. You can just work at a company and you can become successful beyond your wildest dreams through equity compensation or just the benefit package at that company.
And living in Birmingham. What I worry about with data centers is that doesn't seem like the case. I think the end of this message is we want to hear from you. We want to hear from our listeners. How do we navigate the grid demands of data centers? How do we navigate the water supply issue with data centers? How feasible is it to put data centers in the ocean, like offshore? What are all of the different options? How do we do this in the right way? Because I'll say this, my ignorant opinion is I sure don't want a data center anywhere close to where I live. Right.
So how do we navigate this next 10 plus years?
I have no answers. I've got our clients skew engineers and our listeners skew engineer. But yeah, I think there's some negative externalities with it. So like, how do we do it in a pro-business way? Minimally invasive, right? There's a baseline amount of invasiveness that comes with data centers at this size and scope. But how do we do it sustainably in a way that supports Texas? And again, economic gain at no cost is, there's tangential consequences. It doesn't matter what the market cap is if we have rolling blackouts like a third world country does.
Right. There are literally tens of millions of people who over the last 50 years, their lives are way better because companies in every industry in our economy have thrived and have compounded. It's hard to see how do we make that equation the same thing for this?
Yeah, I would love to hear from our listeners on it. And we might find a time to go more in depth with it. I think it's really fun talking about Berkshire Hathaway and SpaceX in the same podcast is kind of jarring because they're just such different playbooks. But it just gets back to the idea of there's so many ways to make money in America. Had you told me as I was riding my skateboard past SpaceX's headquarters that were just in some underwhelming office building that this was going to be a $2 trillion company, and you would have explained to me exactly the past as it's happened, I don't think I would have believed you. Right. So like, it's just such a testament to buy good companies, buy all the companies, because it's really hard to tell what the good ones are going to be. Just own them for decades. Well, that's all I got. So we got a big ask for the listeners. We'd love to hear from y'all. How do we manage this data center stuff well? Ideas for future episodes? podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.
Thanks for listening to this episode of the podcast. You can subscribe or connect with us at brownleewealthmanagement.com. Or send ideas for future episodes to podcast@brownleewealthmanagement.com. Thanks, and we'll see you next time. This podcast is for informational purposes only. Nothing discussed during this show or episode should be viewed as investment, legal, and tax advice. If you have questions pertaining to your specific situation, please consult the appropriate qualified professional.